Felix and Winston here, and a lot of people are saying, look, the rally's gone too far, the year is done, it's only going to go downhill from here. But is that true? If you look at the statistics, every single time we had a rally like this in the first half of the year, what happens in the second half of the year, Winston? What do you say? We had a really brilliant second half of the year too. Statistically, that's true. Statistically, you'd go up another 8 to 10%. And the question therefore is, what stocks do you buy? What do you sell? If you're looking at and you're worried that maybe the AI rally has gone too far and that tech stocks are expensive,
so
you know, Microsoft,
everyone has their phone,
Yes.
Yes.
Yeah, okay.
That's the captain asking me that I've got my phone, which I do, because otherwise I wouldn't be doing this. So what that means is you can look at the stocks that haven't performed as well. Why? Because the stuff that's performed really well this year is what hasn't performed well in 2022. So that's always the way it works. It's a cyclical thing, right? So we're looking at the kind of things that are great quality stocks, lots of free cash flow, big gross margins, your MasterCards, your Visas, your Philip Morris, your Strikers, your McCormicks, your IDEXs, all those kind of stocks. And of course, this isn't financial advice. I'm not saying you should chuckle your money at those, but it's worth looking at. And you can buy stocks that have only gone up 10% and that are still at not above their all-time highs like your Nvidias or your Microsofts, and you can actually get a much better value. And then in the long run, if you DCA into them, you buy a certain amount of those stocks every month for the rest of time, you actually end up with a really glorious portfolio, and you kind of balance out this potential rally bubble, whatever it might be, and we never know how long these things last and all of that. And that's essentially what I do. Now the second thing is that, it's getting a bit loud here. The second thing is the bond trade is still very much alive, as Winston reminds me down here, and that's because bond interest rates are going to either go up or stay flat for an extended period of time. So if you think they're going to come down at some point, say a 10-year US Treasury bond, if interest rates get cut by 1%, that 10-year Treasury bond should increase in value by about 10%. Financial advice, but sort of historically, that's around about right. For a 20 or 30-year bond, it would increase by 20 or 30% in value, give or take. So a lot of people are still buying government bonds, not because they want 4%, not because they want to hold them for 10 or 20 years, but because they're waiting for the increase in value. Bonds are issued at 100 and they drop when interest rates rise. So not buying TLT in my view, because TLT, every single time you buy, it's an ETF, they have to go out and they have to buy at market price. So you get this kind of average holding, lots of different lengths, you don't really know what the maturity is or the yield to maturity. Instead, I pick individual government bonds, look at a really good yield to maturity, but really, you're not looking to hold this thing at the end of time, you're looking to hold it until interest rates get cut or expected to get cut, at which point you might get a nice 10-20% rally there, and that's hedging your Nvidia, your Microsoft exposure, your Google, your Tesla, whatever it is. So that's what we're doing, and we're about to take off, so I've got to turn this off. I wish you a beautiful trading day. I'll be back a little bit later in the day.